A big week in U.S. economic data. I'm Lisa Bernhard with Reuters. And joining me today is Eric Lynch of Scharf Investments to sum it all up for us. Eric, let's start with the data out today, which is the inflation data, the Personal Consumption Expenditures Price Index, or PCE, from the Commerce Department. We know this is the Federal Reserve's preferred inflation gauge. So we've come all the way down from an annual rate of 9% inflation 2 years ago. We're now hovering at about 3% inflation, and we've kind of been stuck there for a little bit. The Fed wants to get us down to 2%. How encouraging or not is this report in that regard? What do you think?
Yeah, it wasn't a great report. Obviously, the market's not reacting favorably today. The reason for that, Lisa, is that we're still stuck on this plateau. It's been many, many months of virtually no improvement. PCE, which is the Fed's preferred inflationary metric, was 2.8% year-over-year growth. It's been stuck there for a while, like I said. There was one small note of improvement, which was the month-over-month increase was about 0.2%, which was a slight decrease from 0.3 the prior month. So it's ever so slightly trending the right direction, but not enough for the Fed to really change its tack.
I think that 0.2% increase that you mentioned was in the core number, right? Which strips away the volatile food and energy prices.
That's correct. And that's obviously what the Fed is focused on. That is also what's proven to be most sticky, right? It's wages and housing and things like that.
So the Fed has hiked interest rates to slow the economy, soften demand, ease up consumer spending to bring down inflation. But how much control does the Fed ultimately have in that regard?
It's a good question because one has to ask themselves, is the Fed even driving the bus? And what I mean by that is, the Fed is trying to control inflation, as you said, with monetary policy, but monetary policy doesn't control all inflationary pressures. And so one of the things that concerns us is basically since the 1980s and this commencement of the great moderation of interest rates and inflation, you've seen this tremendous kind of deflationary forces. You had global supply chain expansion, you had generally, freer trade, you had, technology and things like that. And now, most recently, you've got kind of the exact opposite of that. You've no longer got a peace dividend. You've got these regional conflicts starting up. You've got a trade war. You've got trade that looks to be more constrictive, nearshoring. So all those things, Lisa, are inflationary in nature. And so I think the great concern that we have, perhaps the market's showing that today, is whether the Fed is even driving the bus. One of the things that was interesting this week is that you had two Treasury auctions, Tuesday and Wednesday, where demand was less than expected, and it drove a bit of a spike in the Treasury yields. So that could be concern about this really large federal debt that we're running, over 100% of GDP. And the interest rate servicing is now one of the largest elements of the annual budget. So these are concerns that the Fed just really doesn't control.
So let me pick up on GDP because yesterday the first quarter GDP was revised downward and consumers are now finally slowing their spending. We've been talking about the resilient consumer for many months now. How significant was that downward revision? And was this the most significant sort of cracks in the consumer that we've seen this week?
Yeah, it definitely was pretty important, Lisa, because GDP was revised down from kind of a lackluster 1.6% Q1 year-over-year growth rate to this new estimate to 1.3. And it was really all attributed to a downward revision in consumer spend. That coupled with today's PCE expenditure metric, which was expected to be a month-over-month increase for consumption of 0.4%, was only 0.2%. And so, those are two kind of data points that actually corroborate what we're seeing as money managers on the micro side. You had two companies report yesterday. One was Nordstrom, the other Dollar General. Nordstrom's flagship brand was basically flat year-over-year sales growth. The Nordstrom Rack, the discounted brand channel for them, was up almost 14%. So definitely a trade down. Also, Dollar General, same-store sales grew 2.4% yesterday. Compare that to Target's report last week, where same-store sales actually declined 3.7%. So definitely you've got cracks at the macro level, and you've also got cracks in companies' reports for Q1.
Right now, as we're speaking a bit before the market closed, the Dow is the only index that's up. The S&P and the NASDAQ are down. What is pushing that Dow up and the others down?
That is a very important question, Lisa, and I'll tell you why. What you're seeing yesterday and today is the risks of concentration and broad equity leadership. And so what I mean by that is tech stocks, the IT sectors, the S&P 500, they were down over 2% yesterday, despite and the S&P was down 70 bips. And so they dragged the whole sector, the whole S&P 500 down because 9 of the 11 sectors were actually up. And today, something similar is happening, where you've got IT sector now down again about 2%, but you've got about half the sectors positive, which is why these non-tech sectors are doing well, which is why you're seeing the Dow positive. On the one side, the NASDAQ is down the most. In between, you've got the S&P, which effectively 30% of it is the IT sector. That does not include, Lisa, things like Amazon, Uber, Alphabet, Meta, which were pulled out of IT a few years ago and put into other sectors. So add those back in, you're talking about an S&P kind of tech sector exposure of over 40%. So the S&P has become a tech kind of benchmark. And so when the tech sell off, the S&P sells off.